Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
We're both property people running our own businesses. This podcast is just us chatting, as we often do, about anything and everything property. Now, in the property world, there are fewer things more exciting than mortgages. So that's exactly what we're going to talk about today. Mortgages and more mortgages. And this is all because Stuart has a mortgage dilemma. So what's your dilemma, Stuart?
Well, for the first time ever, I'm kind of in a bit of a quandary about which option to go for. And as a bit of background, for the first few years of my property investing, I was always very clear of what I was doing. Doesn't mean I knew what I was doing. It means I was clear on what I was doing. It might have been the wrong thing, but I was very kind of clear on what I wanted to do. And that was, I was trying to build a portfolio and remortgage the properties that I'd bought as quickly as I could to unlock that capital. And typically that meant that the mortgage products I would go for would have been shorter time frames, i.e. 2 year, because they would get less early redemption charges, or ERCs, as we call them. And that was quite clear. Now, everything's shifted because most properties I've owned for 5 years plus now, at least. And the most recent set of mortgages I've been offered were a 2 year discounted variable. We can talk about what that means, but a 2 year discounted variable, a 2 year fixed, so fixed at the percentage rate, and a 5 year fixed. Now, usually I wouldn't have even looked at the 5 year because I just think that's too far away. And the early redemption charges, the ERCs typically were like 5% for the first year, 4% for the second year, and so on. So, for example, if I had remortgaged with another company in the first year, I'd have to pay them 5% of the total borrowing that I had with them. Now, the interesting thing here, and I know you'll have quite a few questions, but the interesting thing for me was that the 5 year rate was 4.39%. The 2 year fixed rate was 3.69%. And I appreciate this isn't always easy when you're listening, but the variable 2 year rate was 3.34, so the lowest. So if you were trying to attract someone to do something, it feels like they're trying to attract me to take the variable rate, which would be, on the face of it, as a monthly cost, the best rate to go for. And where I'm at now with my development is actually, I'd made a decision, I now want everything just to button down for 5 years, because I don't want to think about it for 5 years. And I kind of just want the portfolio to do its thing in terms of stabilise and hopefully, appreciate a little bit rather than doing what I do. So I'm, for the first time, in a bit of a dilemma because the 5 year rate, though, is the highest rate. So that's kind of putting me off because obviously that lessens my net return.
Indeed. So we've got lots to talk about in here and consider. But before we do you want to just give a quick explainer on discounted variable and what that means for a mortgage?
Well, the variable bit I can do.
Surely you know what the word discount means.
Well, discounted is what I just assume is their introductory rate on that product. So that's my understanding.
Do you know what their SVR is, what their standard variable rate is at the moment?
It will be over 6%.
Okay. So I don't know, perhaps as a making numbers up thing, maybe their variable rate is 6.34%. And my understanding of a discounted variable product is that they take their variable rate and apply a discount of it. So, or discount to it. So in this case, perhaps their discount is 3%. So that would take your 6.34% standard variable rate down to 3.34% as a discounted variable. And I'm sure there's lots of different flavors for this, but the discounted variable products that I've been offered in the past have been for a fixed term. So the discount bit, has been for a fixed term. So it's, 2 years maybe. And during that 2 years, the discount remains the same. So you always get 3% off, but the standard variable bit, the variable rate can of course change. So it might be at the moment that it's 6.34 with the 3% discount, take it down to 3.34. But next month, the Bank of England could put up the base rate by, 0.5% or whatever. And therefore, your bank might put their rate up by 1%. So now you've got a 7.34% standard variable rate minus your 3% discount. and the rate you're actually paying is 4.34. So that's my understanding of how a discounted variable rate mortgage product would work.
Yeah.
And then, of course, at the end of the 2 years, in the same way as when your fixed rate expires, or end of 2 years, 5 years, whatever, then you jump back up to the standard variable rate without the discount or the fix or the whatever.
Very well explained, and I think you've explained that very well. And I'm going to take one quick step back, just so people are clear. Like how I see this, there are a number of decision points for a mortgage. This is how I see it. So, first decision point for me is whether or not it's variable or fixed. Am I going to get? So typically, when I started out in buy to let, everything was fixed. So I knew for whatever period of time, typically 2 years, exactly what my monthly mortgage was going to be for that 2 year period. That was another reason for me picking the fix. So the first option was fixed. The second is you've got your interest rate. So what the bank's going to charge you. So in this case, let's just say 3.69 or 4.39, whatever that is. The third decision point was fees. So what fees are the bank going to apply? What fees is the broker going to apply? Because they will vary depending on what they want you to buy or what they don't want you to buy or what there's promotions on. And then the final thing for me, there might be other things, but the final thing for me was the ERCs, the early redemption charges. So for example, the variable product has no ERCs. So we could take out that product and in 6 months, I could redevelop that property and remortgage it either with this bank or another bank, and there would be no additional fees to pay. The other two products do have ERCs, and we've just talked about what that actually means. So I just wanted to just step back and say, actually, when I see these things, they're the sort of 4 decision points in my head. Am I clear that on what interest rate? Clearly, I'd always want to go for the lowest. However, what fees are attached? Are there ERCs? And then I've got the fixed and variable element. Am I concerned about interest rates? So I just wanted to step back on that just quickly for a bit of perspective.
Yeah, I think that the fees point is especially important. So from my personal point of view, I've never really worried about the ERCs because I've always worked on the assumption that I'm going to see out the fixed term because I'm looking for the longer term, and I'm not trying to cycle capital out super fast. But the fees can be so important. I have in the past been looking at a 2 year fix and a 5 year fix where the 2 year fix was actually, despite having a low interest rate, was actually significantly more expensive because of fees. So if you're only going for a 2 year fix, you pay some fees normally, probably, and you can of course expect that in another 2 years you're going to have to go on to another fix, which means you'll have some more fees to pay. Whereas in a 5 year fix, obviously you only pay those fees once for 5 years rather than 2.5 times across those 5 years. So when you work all that out, the 2 year fix actually worked out significantly more expensive despite the lower interest rate. So don't forget the fees. Make sure you include the fees in the calculations.
And to be honest, Simon, that is my learning in the last 5+ years, is that I've probably paid as much in fees. No, I haven't paid as much, but I've paid a lot in fees as well as paying that interest. And that was another reason. It's like I just wanted to remove additional costs from the business. So even with a remortgage, so when your initial rate runs out, so on the typical products, once the 2 years runs out, typically the banks I work with, Kent Reliance, One Savings Bank, you're paying £500 for a valuation, which is on top of the fees, by the way, for a lot of people, and your broker's fees. So what we're talking about there is, and we're probably talking of sucking eggs for a lot of people, but so I take the interest rate, we'll times that by 12 or 24, whatever the term is, plus my fees, plus the valuation. That is the real cost. That's the real cost. And being completely honest, did I always do those calculations in the early days? I didn't. I absolutely didn't. But what I know now is that, and that's why my eyes were on a 5 year fixed, because for 5 years I know there are no more costs. So I've got a monthly fee, and that's what I'm going to pay for 5 years. And that's what I'd quite like to do, given the fact that we all know interest rates cannot get any lower. But given that the 2 year rates are a percentage lower than the 5 year, we're talking about what would we save in those periods of time.
So before we dig into the pounds and pennies, I just wanted to check something about this particular remortgage that you're going through. Am I right in thinking you're actually going for a lower loan to value than your existing mortgage, or is it the same?
It's a lower loan to value on a higher valuation.
Ah, okay. So are you taking any more money out, or are you just staying at the same level?
If they'll give me some more money, yes, I'll take that money.
Okay, cool. You were talking about consolidating and thinking for longer term, because previously you were going short term because you wanted to keep cycling and keep taking out capital as quickly as you could. And now, of course, you're looking at longer term and not taking that capital out. So I wondered if you were also taking any capital out or not, sort of at this initial point.
It's a really good question, because my original assumption was that I wasn't taking any money out. And the valuation that I put in for was only 10,000 more than what the last valuation was. And I don't know if I've shared on this podcast previously, but the ridiculous nature of our wonderful banks is that their current desktop valuation meant that the mortgage that I am currently on, the loan to value was higher than what they would allow. So just to explain that quickly, the mortgage product I currently have and I'm about to change was an 85% loan to value product. However, when Kent Reliance did their desktop valuation, they were saying that basically they were undervaluing the property and said, actually, based on the current valuation, we're loaning you 86%. Therefore, we have no other products to give you. That meant I had to go on the standard variable rate, which obviously I didn't want to do, because who wants to go on that? Because it's ridiculous. And therefore, that pushed me into a corner where I had to pay for a valuation just to get someone out sensible to value the property at where it should be valued. They valued it as it should be valued. And now we can get the 80% loan to value product on it, which is actually what I wanted. But it turns out that the right valuation at that LTV would unlock a few grand, genuinely a few grand. It's not going to be more than 5 or 6, which isn't a huge amount of money. However, if it's there for whatever 3.69%, we'll probably take it just to help the business along.
Yep, and why not? It's makes sense too. We plan our topics for these podcasts, and then we start recording, and it's quite rare that we actually get through half of what we planned. And I suspect today might be another example, because I've got some mortgage questions coming up as well, sort of next year probably, particularly around the loan to values that I'm going to be able to achieve. So I don't know, we'll park that for now and perhaps cover it in another episode, because I suspect we won't get to it in this one. But anyway, let's talk about the actual figures. So you've got 3 mortgage options: discounted variable, which is 3.34%, 2-year fix, which is 3.69%, and a 5-year fix, which is 4.39%. These are all on a mortgage value of £208,000.
That's right. Property valuation at 260,000 at 80% loan to value gives you 208.
Do you want to tell everyone what the monthly mortgage payments will be for in each of these scenarios? So we've got the discounted variable.
Yeah. So this is just based on my maths. I imagine the pounds and pence will be slightly different from the bank for whatever their calculations are. But all I've done is taken the loan amount of 208,000, times it by the interest rate, in this example 3.34, which gives us the annual rate, and then divide that by 12 to give me the monthly figure. So for the 2-year discounted variable at 3.34%, that gives me a monthly payment of £578. The 2-year fixed is £639, and the 5-year fixed comes out at £760.
Right. So if we take those monthly figures and multiply them up for the first 2 years, so we're working on 2 years based on the fact that sort of the earliest stopping point is the 2-year fix. So we're comparing over the first 2 years. So do you have the total amount of interest paid for each one over those 2 years? Or I've got those figures in front of me, Stuart. Do you want me to read them out, or have you got them ready?
Yeah, I've got the 2-year variable would be 13,872.
Okay, and the 2-year fixed.
15,336.
And then the 5-year fixed, but just over the first 2 years,
is 18,240.
Right. So everyone can hear that there are some fairly chunky sort of steps up between each of those. So do you have those differences to hand as well, just to save people trying to do the mental maths?
Well, the difference between, and this is where it gets a bit more challenging, I think, if you're listening to it, but the difference between the two years, so the 2-year variable and the 2-year fixed, this is coming live and direct. It's a difference of £1,464 between the 2-year variable and the 5-year. So these are the sort of like it's going to be the biggest difference. Is £4,368.
Mm-hmm. So that is a big difference.
Yeah, and then roughly between the 2-year fixed, and we'll just do this roughly, but the 2-year fixed and the 5-year on that 2-year period is roughly £3,000. We can see that.
Yeah. So if you went for that discounted variable, you could save yourself £4,500.
So tempting.
Give or take. But you've got to make sure that the Bank of England doesn't put up their rates. So can you do that? Can you guarantee us for the next 2 years that there'll be no interest rate rises?
I don't think even Mark Carney could do that, could he?
Not anymore.
But he certainly can't now.
Exactly. So, I mean, it wouldn't take very much of a difference to push you over the edge. So if your bank's variable rate, because obviously that's different from the Bank of England rate, which will probably go up very slowly, but the mortgage standard variable rates will probably go up a bit faster if the Bank of England starts pushing things up. So it would only need to go up by 1.1%, and you'd be looking at the same rate as the 5-year fixed. So that's your savings gone. Of course, you might have savings for a little while. So if that happens sort of during the process, maybe it would still kind of equal out. But a bank rate, so not a Bank of England, but a mortgage bank rate rise of 1.1% or more over the next 2 years, I could certainly see happening. So I would be personally very worried about committing to the discounted variable rate.
Yeah.
The one sort of safety net there is that you don't have ERCs on it. So as things started going up, if you reacted quick enough, maybe you could remortgage off of it onto a fixed rate, but then of course the fixed rates would also be higher by that point. So I don't know.
Well, that's a really interesting point you've just raised there as well. And this, I feel like this is therapy for me, and I'm quite pleased that you and I get to take this time out. And I would genuinely be pleased to hear from anyone with additional thoughts than ours on these matters, because it all helps, doesn't it? It all helps to hear different perspectives on why you would or you wouldn't take an option. And that's kind of why we've done this particular podcast. But usually, I mean, I wouldn't say I would consider myself a risk taker, but I probably have a greater resilience towards risk, as in I'm happy to take risk. And for me, I always think, 2 years, it's not a big risk. However, in this instance, personally, I feel like the risk is greater just because already there's kind of, obviously we've said this for years, whether, the interest rates must go up, they can't stay this low forever, and that's lasted years. However, I do feel like the noise we're hearing, because they didn't go up this time in this budget, I feel like we are getting closer to that time. So I think, in the next 12 months, there could be that increase. And like you say, as soon as that, even if it's 0.5% goes in, that's, for sake of argument, that's almost half of your savings gone. And bearing in mind, I've got, a 5-year product to consider. And then the other element, which we have drawn out, but we don't take into these totals, is the fees, because we don't know. So if I put for example, if the fees on the 5-year was only 500 versus it was £1,000 on the 2-year, then of course that goes into the equation, and all of a sudden the decision becomes a little bit easier. But my feeling right now is that even though looking at the total numbers makes this a lot clearer, and I think, blimey, to save just over £4,000 in 2 years, that'd be silly. Two things is that I'm worried, concerned about the interest rates, but then that 2 years comes around really quickly, and I have to make that decision again. And what will the rates be like then?
Yeah. Given that we are almost certainly in an upward interest rate trajectory for the coming couple of years, then yeah, exactly. I think it's all about taking a stab in the dark as to how far and how fast you think those rates are going to change as to what would be actually really better for the interest you pay. But then when you throw in fees and the hassle and the effort of having to remortgage again in 2 years' time, then yeah, I can see the appeal of the 5-year fix. And indeed, that is almost always where I come down in my own sort of musings on this. But yeah, the other thing that we haven't really sort of touched upon, but we should just touch upon, I'm sure it's not really going to be a factor in this particular case for you, Stuart, but we should also look at cash flow, because the discounted variable one is 560 quid a month, give or take.
Mm-hmm.
And every month, that's quite different from the 5-year fix, which is 760 quid.
Yeah.
Oh, sorry, so the first one's 580 quid. Sorry, misread my own numbers. 580 quid versus 760 quid a month. So almost £200 difference in terms of monthly cash flow. And for some people on some properties, that could be important. I'm quite sure that you're not that close to the wire on this one, Stuart. But yeah, I think it is worth people looking at that and considering that as well.
It's the difference between the mortgage being 25% of your revenue and around 30% of your revenue. So whatever scale you're looking at, that, well, in my mind, that's fairly significant. And it is a good point, because I guess the last thing to talk about is that obviously I've looked at that, and once again, the 2-year variable is really appealing from that point of view, because I think, oh, that's 200 extra quid in my back bin. But I now, that for me was the short-term thinking that I had several years ago as someone that needed the cash flow, and I still need the cash flow, and that's why I still am in two minds about it. However, yes, that this property can stomach an extra £200, because actually the 5-year rate covers both the existing mortgage and a further borrowing that I had on the same property, which combined comes to higher than that £760. So we're getting a little bit more money out and we're paying a little bit less, if that makes sense. So let's just say at the moment, with my further borrowing and existing mortgage, I'm paying in excess of, well, around the same amount. Let's just say that. So actually, it just tidies everything up. The truth is, right now I'm on a standard variable rate. So standard variable rate plus the further borrowing is close to £1,000. So each of these is saving money. Again, that's short term, because that's only happened for a month, because it's taken us so long. Well, I say us. It's taken Kent Reliance so long to sort the valuation out that we got pushed into it. And it was my fault for not approaching this earlier. So, but that is important. That is important, because it's gone from what could be a quarter of my revenue to a third of the revenue, which does make a difference. But, for me now, because of my experience, it will be, I'm erring to the side of let's fix this for 5 and, think about it again, in 5 years' time.
Yeah, just ouch for the standard variable. But as you say, that means that you'll be saving on cash flow, even with a 5-year fix. You'll be avoiding any more mortgage hassle, questions, uncertainty for 5 years. The interest rate's not going to change. Your cash flow is not going to change from the mortgage point of view for 5 years. You're not going to have any mortgage fees or valuation fees for 5 years. I can see the appeal of that. And I think the only argument, well, I suppose there could be 2 arguments against a 5-year fix. One is obviously if it's just so much more expensive that it doesn't work out. But the other really is if you're wanting to recycle cash faster, as in you're wanting to be able to get a valuation that's higher and pull more money out of it faster. So every 2 years when you finish the 2-year fixes. So without those, well, actually, I suppose there's a third, isn't there? Of course, if you're expecting interest rates to change very dramatically, then that could also really influence the decision. Also change very rapidly in a downward direction to favour the shorter term mortgage. I should clarify that. But yeah, the 5-year fix, I think it's a very sensible option. In terms of the interest rate, it sounds a lot more, and when you turn it into cash, it sounds a lot more, but it wouldn't take very much in the way of fees or a tweak to standard variable rates to eat all that up. And then you've got no extra money, and you've got the hassle and the extra work and things. So.
Well, and just having this conversation, the thing that it's underlined, and I know we're going to wrap up very shortly, but the thing that it's underlined is that, so I think if we went for a 2-year, whether that's a variable or fixed, so right now as the cost stands, I know that would be an extra, in 2 years' time, there's going to be around an extra £1,600. Going to have to pay an extra £600 for a new valuation, because that'll happen, and then £1,000 for fees. That's if there's no inflation for the next 2 years, by the way, which of course there will be. So of all those numbers I've done, I could just knock off, to compare it. If I want to compare like for like, actually what we should do is knock off £1,600 off the 5-year cost, because we've just saved that in that time. So that would take it down to 2.7. So in real terms, the difference is probably much smaller, and the risk. Although, like you, I look at the 4.39 and going, wow, I'm not getting much in return for committing with you guys for 5 years, but they don't really want that ultimately. So they want you to pay for it if you're going to have to stick with them for 5. But it's certainly been a useful conversation for me to have with you and those listening. So as I mentioned before, I'd be really happy for us to get any views, additional thoughts on how you would approach this situation, as you no doubt have or will have very soon.
Indeed. And if you're listening and you would like to get in touch and let Stuart know how you would approach this situation, or how you have, you can find a contact form for us at thebusinessofproperty.com, which is also where you can find show notes for this episode and all of our past episodes. We're up to over 100 now, which is crazy, but there you go. We are still going, so we will talk to you again next week. And if you would like to help us, inspire us to keep going longer and longer, please do share this episode and the business of property generally with 2 or 3 of your friends and landlord and property contacts. We really would appreciate that. And Stuart and I will talk to you again next week.